Welcome to Profile Traders. This is Reza, and we are looking at an introduction to market profile theory. This presentation is a brief description of what market profile is, and it is not an attempt to teach you the whole method nor its full trading application. It's just to give you an overall view of what market profile, and I'm talking about traditional market profile, is all about, so you get a better understanding when you look at it. First element, what is market profile? Simply, market profile is a method of displaying market data using the concept of the statistical bell curve. When we look at a statistical bell curve as below here, we can see that there is a distribution of price within this statistical bell curve with several areas that are highlighted by the brackets. Basically, from this point on to this point on, you have the standard deviation number 2, which contains 70%, or in this case 68.3% of all the transaction. The middle of it is the most accepted price or fair value, which is standard deviation number 1. And then above you have standard deviation number 2 and number 3, which are the extreme highs and the extreme lows of the bell curve, which we'll be analyzing a little bit down the road. So, market profile attempts to take market data and distribute the market data within the statistical bell curve, so that we can then read the same information that we can gather from the statistical bell curve applied to the market. Now, why use the statistical bell curve? When a series of market data is collected and distributed within the statistical bell curve, one can obtain very valuable information regarding the targeted market. Number one, the statistical bell curve allows to visually identify the most accepted price by market participant within the standard deviation number 1 or fair value. So if I go here, the middle is going to always tell me which price within the statistical bell curve was the price the most accepted by the traders. So the belly of the statistical bell curve, standard deviation number 1, will represent that. 2. It allows to identify a range of price perceived as fair by market participants, also called value area, standard deviation number 2. Meaning, this line bracketing this level to this level, that's where 68.3% of all the transaction taking place. That means if you transact anywhere in that zone, you are close enough to the most accepted price by the market participants so that your transaction is still fairly valued. Because the farthest away you transact from the middle to the upside, obviously it becomes super overvalued, and the further down from the middle, it becomes super undervalued. But if you are somewhere within the area of the middle, you are still buying or selling reasonably compared to fair value. And that's what this bracket is trying to contain. 68.3% of all the transaction, also called standard deviation number 2, also called value area. 3. It allows to identify the range of price perceived as either overvalued or undervalued. So if we pass standard deviation number 2, this area here becomes overvalued, this area undervalued. Now I know exactly, when I look at this statistical bell curve, I can realize where is a fair area for me to transact and what areas are considered overvalued and undervalued. And also it allows to identify the range of price perceived by market participant as grossly undervalued or overvalued. Meaning if we get to the very extreme high or the very extreme low of the statistical bell curve, that's where we are going to encounter extreme overvalued at the high and extreme undervalued at the low. This is another display of the statistical bell curve. So middle standard deviation number 1, this is the fair value, most accepted price. The bracket yellows above and the bracket yellow below will contain the value area where 70% of the transaction took place. Above that is overvalued, and then standard deviation number 3, which contains 5% of all the transaction, is extreme overvalued, and the same principle is duplicated to the downside. Below the orange line, value area is moderately undervalued. This area will contain 25% of the transaction, and then below the red line you are dealing with extreme undervalued, which will contain 5% of the transactions. So what you're looking at is a simple understanding of what the statistical bell curve is all about and what kind of information it gives us. To make life simple, just remember that the statistical bell curve will allow you, when you enter a market, to know if you are transacting at a reasonably fair valued, or if you are transacting at overvalued areas or undervalued areas. We will analyze this more in details going forward. Now, price versus value. In theory, price is a specific monetary amount market participants are willing to pay for an item at a given time. Very simple. If I ask what's the price of 1 pound of carrots, they're gonna tell me it's $6 or whatever. So that dollar amount assigned to the item is price. However, value is different. Value is a range of price market participants conceive as fair and reasonable to pay for an item. So if you go buy something, you have an idea of a price range that you are willing to pay. Let's say you are buying a shirt. You do your research, you realize that this is the shirt that I want to buy. You do some research about it and you see that the price range goes from, let's say, $50 to $65. You know that if you can grab it below 50, you're getting a good deal, and if you're paying above 65, you're paying too much. So you're going into the market with in your head having a price range that you consider fair. So that price range is value. Without knowledge of what is considered a reasonable price, price alone will provide market participants very little to rely on. So as a result, if you don't know what valuation is assigned to whatever you're transacting with, you can end up paying too high or selling too low because you have no idea of what value is for the product that you're dealing with. So there is a big difference between the two. Price alone will tell you nothing about value and can be very misleading. But if you know what value is for what you're buying or selling, then you know that the price you're getting within that value range is overvalued, undervalued, or fairly valued. So big importance and big difference big importance to distinguish between price and value, and big difference between the two of them. Informed versus uninformed market participants. Informed participants research diligently market they want to interact with. They have a perfect knowledge of both price and value when they enter a transaction. As I said, without knowing what value is for a particular asset, they are at risk of paying too high or selling too low. For the informed participant, focus is on value rather than price. Uninformed market participants enter into a transaction without any knowledge of valuation. Their sole focus is price and often end up buying too high or selling too low without even knowing, because they have no clue what the value is for the product that they are buying or selling. So focusing on price alone make them at times sell too low or buy too high, and every time that such transaction took place, the loss or the gain is for the informed participant that is on the other side of the transaction and benefit from it. To make this more clear, let's look at the example of buying a home using the statistical bell curve and price histogram. When you want to buy a home, what do you usually do? You select an area, you select a price range, then you do your research, you come up with comps, see what sold at what price, and then you make a list of what is available for sale on the market, at what price, and then you enter the market informed about past transactions, so that the house that you're looking at, you will know if it's reasonably priced compared to what took place previously in terms of buy and sell, and you get an idea of how much you're willing to pay. So if I take that market information and distribute it within a price histogram, I can then see to the left hand price. So let's say the price that I'm looking for the home goes from $425,000 to $275,000. This is the range of price that many transactions took place within. Then I know that at $275,000 only 10 homes sold down there, and at 425, same thing. Then 400, 375, 350. This tells me majority of the transactions for those homes took place right around 350,000. So if I come into the market and then all of a sudden I see that somebody is willing, or somebody is uninformed and is willing to sell his home at 300,000, obviously I'm going to jump on it, because if I buy it for 300,000 and I sell it at an average price or the most accepted price, which is 350,000, my gain is going to be 50,000. On the other hand, if I come in and I see that somebody is trying to sell a house, the same house, for 400,000, I know that it's a very bad deal, because if I buy it at 400,000 and I want to go ahead and sell it, most likely I will be getting around 350,000, and right there I'm losing 50,000. So this distribution of price within this histogram gives me a fantastic advantage of knowing if the price that is offered to me is reasonable, or if it's a very good deal because it's undervalued, or if it's a very bad deal because it's overvalued. And you reflect this now to the chart on the right, and you get pretty much those levels that we talked about. So you want to transact as much as possible within the 70% range of all the transactions, and as close as possible to the middle. Anything away from the middle on the upside is overvalued, and to the downside is undervalued. Therefore, you want to be an informed participant when you enter whatever market it is that you are entering. And buying futures, stocks, commodities, it's no different than buying a TV. If you go in there just looking at price, you're clueless. But if you go in there with an idea of what valuation is for what you are buying, you are much better informed than 99% of the people that are on the other side of the transaction. Now, standard candle charts. Most market participants base their buying and selling decisions on standard candle or bar charts, as the one displayed below here. The focus of these charts are purely channeled towards price. The information we can gather from them are limited to, if you look at any of these candles, you have the high, you have the low, you have the open, and you have the close for each candle. You also have a very good view and idea of past price fluctuation over time. For example, here I can see that this chart of the S&P E-mini future daily has gone up, for example, from October of last year all the way to January, February, pretty much straightforward up. So I know how price fluctuated within time. I can also have various candle or bar formations based on candle analysis, bar chart analysis, etc., like dojis, hammers, all kind of other candle formation that is left open to personal interpretation. And last, I can also use technical analysis pattern formations and their projected implications, such as the wedge that I have drawn here on this chart, which is now exiting to the downside, which has its implications and can give you pretty much idea of what you should expect from this technical analysis application. But still, you have absolutely zero idea of value. All you are focusing on are a bunch of other things, price related, that will not provide anything about valuation. Now let's look at market profile chart and how it's built and why is it so different from other methods. Market profile charting is a method of displaying that same market data that you see here, but in a way that it would fit into the statistical bell curve. So the dilemma is to take a market that fluctuates on your daily or on a candle chart vertically and find a way to fit it into the statistical bell curve by making it fluctuate horizontally, as you're seeing in here. In order to do so, market profile charting subdivide the trading session into 30 minutes brackets and assign a specific letter to each 30 minutes. So the first 30 minutes from the open of the day session, a letter is assigned to it, being letter A. So market opens at 9:30 till 10 o'clock. As price will go up and down to new price levels, a letter will be printed on the chart. Let's say I open at 1829.75, market goes down to 1829 half, a letter is printed. It goes further down to 1829 and a quarter, another letter is printed. It goes down to 1829 even, a letter is printed. Now if it goes back up again 2 ticks, nothing is printed because that price has already been traded through. But if it goes further down, more new letters are printed. So the horizontal the vertical fluctuation will make the chart print you letters at every new price discovery that takes place within that first half an hour, and then when it's finished you get a picture of what the first half hour did in terms of its price fluctuation, and it's all reflected by the letter A. Then when the second half hour starts, where this little O is within B period, same thing will happen. Price goes up and down. Every time it goes up to a new price level, a letter is printed at that price, and it will fluctuate up and down vertically until it's finished. Then letter C comes, then letter D, etc., all the way to the last 15 minutes where the letter N comes in and closes the session. So you get the idea. Rather than having a horizontal fluctuation, we get a vertical fluctuation. Each half hour is subdivided and a period with a letter is assigned to it. These letters are called time price opportunities, or TPOs. Now I still cannot see any statistical bell curve here. I see half hours going up and down vertically with letters, but I do not see a statistical bell curve. In order to do that, we need then to combine these separated letters, which I have separated to display for you and show you how every half hour fluctuates vertically rather than horizontally, and also to make you understand how these letters are printed every time that price goes to a new price. Now if we go to the next page, it's following the explanation of what I told you a little bit more in details, the 30 minutes brackets, the letters, etc. So that we already reviewed. Now I take all those 30 minutes that I showed you above and I put them all together. Now I have a very clear statistical bell curve. And with this statistical bell curve formation, as we saw at the very beginning of the presentation, I am able to extract several very important pieces of information. One of them being fair value price. The fair value price, if you recall, was the price the most accepted by the traders. Then I can extract my value area. That area was where 70% of all the transactions took place. Then when I have my value areas, I know if it goes above it, it would become overvalued, and if it goes below it, I know that it becomes undervalued. So how can I now have fair value, value area plotted on this chart? Very simply, the software will do it for you, and the result will be shown below. For example, I asked the chart to plot for me the fair value, which is this thick blue line. For this session, which was the 23rd of January, the price the most accepted by the traders for that session was 1823.5 or 1823.5. This is also called the point of control, which is your standard deviation number 1. In any given balanced market, balanced market means that nothing from outside event or news or something that is unpredictable has influenced the valuation of the market, and you're in a state of balance. When market is in a state of balance, price has a tendency to fluctuate around the point of control. So look at it as a magnet. In a balanced market, if you know what your point of control is, when price gets too far away from it, it has a tendency to come back to it. And then if it gets too far away from it, it has a tendency to come back into it. And this is very natural, because for you to get a balanced statistical bell curve, the belly of the statistical bell curve has to be the fattest, and it becomes the fattest because price has a tendency to come most of the time to the middle and puts the most transaction towards the middle belly part of the statistical bell curve. So it's very important that I know for this session that the most traders accepted this 1823.5 as a fair value. Again, the software will be able to pinpoint that price level automatically for you. Now, I also ask the software to put in the value area for me, which is bracketed by the orange lines. The upper side of it is called upper value, the lower part of it is called lower value, and the distance between upper value to lower value is called the value area. That's where 70% of all transactions took place. So from 1817.25 to 1824, that's the range of our value area. When we look at a value area, there are several elements we look for. Number one, when I look at on a daily market profile chart, let's say over a week or over 3 days or over 4 days or over 2 days, the first thing that I am very concerned with is the direction of the value area. Is value area shifting higher? Is the value area shifting lower? because that's what really matters to me more than what price has done. If value area shifted higher and price ended up not following, still the bias overall is positive because market said that value area for this item is now moving higher because of higher demand. If value area is shifting lower but price end up closing at the high of the session, you need to be concerned because market says value area for this market has shifted lower. Now because price came and closed at the very high of the session, it doesn't mean that you should be drinking champagne because everything looks positive. On the contrary, because value didn't confirm price, there may be danger signals down the road. Then I am very much so interested by this value area high and value area lows as areas of support resistance when I come in the market the next day, because I already have the picture of the previous day session. I know it's value area high, I know it's value area low, and I have a very good idea of what was perceived as value by market participants. So if I open at the above the value area high, then when price comes to this value area up here, I know that this is one area of support. Then if it comes to the POC, I know it's another area of support. If it comes to lower value area, then another area of support. So to make a long story short and not going too much into the exact details of the trading application of it, you want to know that value area high, value area low, and the point of controls are all very, very important, valuable support resistance levels based on the previous day when you enter the market the following day. I'm also looking at the width of these value areas to measure the enthusiasm of market participants. The higher or the wider the value area on any given day as we go up and down, it tells you that market is very comfortable with that move, because the more market participants you have in a move or during a day, the more ease of movement you get. Therefore, your value area will be wide. The moment you start to see a shrinkage of your value area width, that tells you that interest towards that move or that session is shrinking, and therefore either you are going to enter a stage of pause or a potential reversal of trend because of the shrinkage of the value area. Also, what is very important is that for the next day, depending on where you open in relationship to the previous day, you can see if there is complete market acceptance of the previous day's value area, or if there is a rejection to the upside or a rejection to the downside of the previous day's value area. And each of these situations will provide you with a specific trading strategy that you can apply to the market, which of course I'm not covering the details in this presentation. This presentation is only a simple introduction to market profile. Now, we looked at value areas, we looked at the point of controls, but these are not the only elements. There are many other elements which I have listed here that I am not going to cover in details, but it's for you to learn what they are and more specifically the trading application of it. The sad thing is that gurus and teachers and market profile experts and gods are all over the internet. Everybody will tell you about the theory. Everybody is now a market profile expert. But when it comes to the trading application of it, unfortunately 99% of the poor people out there are clueless. So it's very important to distinguish between knowing market profile theory and also knowing how to apply it with very specific trading strategies to live markets. That's a totally different purpose than what I'm trying to achieve here. Here is just to give you a basic introduction so you understand the concept. But it's under no circumstance trying to teach you trading application for that. So other elements that you're looking for is the type of opens. Open is always the little blue dot within a period. The way open is positioned within the a period or the first 30-minute bracket tells you a tremendous amount of valuable information of what you should be expecting at least for the first hour and a half of the market, and oftentimes allows you to position yourself very early in upcoming moves based on how and what style of opening you get from the market start within the first half hour of trading, circled by this little blue dot within a period. Then you have to be concerned with the opening range, which is the green bracket, how it's broken to the upside or to the downside. Should you take the break out of it? Should you wait? Etc. Again, trading application which I teach but not cover in here. Then you have to deal with your initial balance, which is the range of your first hour of trading, which brackets the high of A period and B period. So A and B represent the first hour of trading. Whatever that range is, which is bracketed by this black line called initial balance. 90% of the time, at some point during the day, price will exit out of that range. Again, do you go with the break? Do you fade the break? Do you pass it? Do you pass on the break? All those things are trading application, not covered here. When price exit out of the initial balance, which is the range of your first hour of trading, it is called a range extension. Once again, knowing how to trade it, interpret it, it's all methods and techniques that you can learn. Buying, selling tail. When you look at the very extreme high and very extreme low of the profile, if you see more than 2 single letters, if it's at the bottom of it, it's a buying tail. If it's at the top of it, it's a selling tail. Basically, not using fancy terms, it tells you if you have letters that are single containing the high or letters that are singles containing the low or the high was swiftly rejected by market participants. Because it was swiftly rejected, price moved very fast through that area of price range, and it didn't allow sideways development, and as a result you only have single letters. If you have a rejection of the top and if you have a rejection of the bottom, it tells you that that top and that bottom is solid. A top or a bottom that doesn't have a tail or a rejection, those are tops and bottoms that are suspicious, and market can easily come back and revisit them. Then you are dealing with areas of minus developments. Again, minus developments are areas that contain only 2 letters, but this time it's always within the structure of the day's profile, not the extreme high or the extreme lows. It has to be with the middle, like right here. Again, indication that price moved very fast and those areas were rejected by buyers and sellers. How you trade them, what to look for, what they indicate, etc., etc. You can learn about it, but not covered here. Then you also are concerned with the shape of the bell curve. It could be a balanced bell curve, such as here, for example. It has the shape of a letter D. Sometimes the balance is at the very high of it. It becomes like a letter P. Sometimes the balance area is at the very bottom. It becomes a letter B. So all these shapes and interpretation, etc., are part of the whole theory of trading market profile. Then you can also see a ledge here which looks like a flat cliff. Again, visual aids of what to expect when a ledge is formed, how to trade it, etc., etc., that can very, very successfully be used when you learn what it means. These are all elements that you are looking for when you trade traditional market profile. Now, if you look at somebody that is teaching you a market profile by putting a value indicator, value high, value low on a candle, please tell him to pack up and go do something else, because by doing so, you are basically depriving yourself from all these elements that I just covered. There is no way that you will see a buying tail. There is no way that you will see a selling tail. There is no way you will see a ledge. There is no way you will see minus developments. There is no way you will see the exact value areas based on these letters. You're gonna see value areas based on volume, which is a complete, totally different story. There is no way you will see the type of open that is extremely crucial to be able to understand and interpret, because those are usually the best trades of the day. So you are depriving yourself of 90% of the information that traditional market profile will provide you. So just be careful. Now let's look at practical application. This is a crude oil profile. We changed it from ES to crude, so that you know it works with pretty much every single instrument that is traded out there. Session 1 is the day. Then session 2 is Globex overnight. Then it shifts to day. Session 3, which is the day. Then session 4, again overnight. Then session 5, which is again the day session. Day session starts at 9 o'clock. Let's look at session number 1, which is the day session. What we can see is that we opened right around 97 and we got an initial drive to the downside, and the drive to the downside failed, because as it extended the range out of the first hour, it immediately stopped and rejected back into your initial balance, which is definitely considered as a failed range extension down. As a result, when you have a failed range extension on one side, usually market has a tendency to go and extend the range out of the initial balance to the opposite side. So when the range extension to the downside failed, we got a reversal, market reversed, went on and extended the range to the upside, and we ended up closing near the very high of the day. The close at the high of the day is telling us that it was a clean-cut victory for the buyer, because the closer you end up to the high, and of course the stronger the will and the buyer has been in for that session. So now, with value having shifted higher, our close being towards the high of the day, the bias for this session becomes very bullish. Therefore, the strategy is that I am looking for the upper value area and a point of control as a support buy for the next session. Next session market opens. What we are seeing is that immediately off the open, value area high was rejected to the upside. Therefore, knowing that, I would wait for price to come down, retest the upper value area. I would go long, and I could place a protective stop below the point of control if you want to be super conservative, or you buy upper value area and then you also buy the point of control and you put your stop below the previous day's lower value area. In this case, the retest of the value area high of the day one worked, and price drove to the previous session high, and at which point it started to encounter resistance. As it encountered resistance, it started to go rotational. When you are at a level and price starts to go rotational, and you can see on the volume histogram volume expanding, it's telling you market is encountering resistance. Then we rejected this upper rotation to the downside and we closed at the middle of the Globex session. When you close at the middle of the Globex session, it's telling you neither the buyer nor the seller won the battle. However, the overall bias is bullish because even the value area of the overnight shifted higher. But because of price closing at the middle and inside the previous day's range, my assumption is that from this middle, price could go easily very early to the upside of the overnight high or to the downside of the overnight low. If the initial move would be to the downside, I would be buying upper value area of the previous day and the point of control of the previous day, stop below the lower value area. And if, because the bias is very bullish still, both value areas have shifted higher, if price from the open exits out of the overnight high, I would like to go with a break out of the overnight. I would like to go with a break of the overnight high, especially if you learn the kind of open that you are analyzing. This open was absolutely without any hesitation to the upside. This was an indication that the buyer didn't even hesitate a second to buy the open of day 3. So I would go long with the break of the overnight high, and I would put a protective stop below the open of the day session, and I would hold this until a range extension to the upside would take place. Now when I come to day 3, I again see that my close, which is this asterisk, happened to be at the lower value area, and it happened to be below the point of control, and it happened to be below today's 50% range, all a little bit concerning. And I can also see that as we shifted higher, value area width wasn't very wide. Again, lack of participation, lack of enthusiasm as it has reached these upper levels. Even though that I have now 3 series of value area shifting higher, the rotation at the very top that was rejected and the close below the middle of the day's range is a bit concerning. So I come the next day, I see that the overnight sold quite aggressively, and the day session now is going to open with a gap down. With this gap down, I am looking for 2 things, like always when you have a gap. Is the gap going to be accepted? If the gap is accepted, you're gonna get a immediate drive in the direction of the gap. In this case, you would have seen a very big push down if the gap was accepted. If the gap is rejected, then as it is the case here, market has a tendency to go close the gap. So what I do is that I monitor what is happening with the first half hour and especially my opening range. If I see that there was no rush to selling it despite this gap down, there is indication that price would come and fill in the gap. If I want to go strictly with the weakness that I have seen in the overnight, I would put a sell order to sell when the gap fills. I would put a second order to sell when the point of control of the previous day is hit. My stop would go above the previous day's high because the value area high is very close to the high. So I would not use value area high as my stop, but I would use the price above it. If I did that when price returned and closed down at 97.40, I did extremely good. Second strategy that you can use is that you monitor, and if you see that there is no rush to selling despite such a big gap down, there is a probability that market will go up and close the gap. You wait, you watch the open. If it comes down, test an area of importance. In this case was a retest of the overnight low and could not follow through further. When it crosses into the open, you can take an open drive long, either against the immediate low put in by the day session 5, or you can use the low of the overnight as a stop, and you would then target to go hit 3 levels here. Number 1, overnight point of control. Number 2, close of the gap. And number 3, your upper value area. In which case, both strategy would have paid handsomely. So, this is pretty much in a nutshell what you're looking when you use market profile. Now to highlight the big difference between the two, what would you rather have? A charting method simply based on price alone with a high, a low, a close and an open, or a method that will take exactly that same day that you see in the candle and provide you with all this valuable information. Again, if you are interested to learn more detail about this, because there is much more to learn how to apply it to trading, please give us a shot. You have my word, I will give you top-notch education and will take you from ground level to an efficient level using market profile successfully. Thank you for listening, and hopefully our path will cross. This is Reza with Profiletraders.com.